Good afternoon, everybody. Welcome to your Fed announcement day on the TraderMerlin show. It was a wild ride. Did not do what I thought it was going to do. We'll look at some of those charts a little bit later on, I'm sure, for the longs. Enjoying your 4% NASDAQ gains. A little rough for me in my portfolio, but I had to lighten some of it up just to be safe. But that won't be the topic for right now. That'll be topic for a little bit later on. We're going to start the discussion with the long, not the short, of options. Nice little graphic here for those listening to the podcast. I got a little sad-looking petrified red arrow pointing down and a jolly happy green one pointing up. Larry Jacobson is here to join us to talk about the long, not the short of options. Larry, how you doing, my friend?
Good, Merlin. Good to be back on TraderMerlin. Hello, everybody.
It has been too long. By the way, everybody, I'm overdosing on Larry. We did a webinar this morning, which was fun, talking about digital assets and cryptocurrencies. We did this, and then we're gonna go out to Benihana tonight. So I paid the guy $10 extra to fling oily shrimp on Larry's shirt. It's gonna be fun.
Absolutely.
How you been, Larry? What's been going on in your world? It's been a while since we've had you on.
Yeah, no, just been busy working on new curriculum. We have some new agendas and new projects coming up. So I've been really kind of just focusing on that. I've had the chance to go out and teach a couple of options classes the last couple of months. So it get me a chance to get back in the classroom, which I always love. And of course, getting to spend a day with you, Merlin, what could be better than that?
There's a lot that could be better than that, but we'll take that as a compliment. Giselle says, Larry, great class yesterday in your trade plan essentials. So awesome. Still doing trade plan essentials, huh?
Yeah, about a year ago, we decided it was time to refresh the trade plan class. And it really, to me, is the most important factor, because if you don't really understand and have a plan, you're kind of guessing, you don't really have an agenda. So I kind of treat that like a New Year's resolution, right? We know that everyone wants to lose weight, get out of debt, or make more money in a new year. The problem is many people plan out. They even get to the point of saying, I will do this, and then never do anything.
Right.
This is why we love to see those gym commercials come up around Halloween. And now we're going to start to see on Facebook and social media all these get rich quick schemes, because they know that people want this to be done on the top of the year, and they know they're going to pay them and do absolutely nothing. So what I like to say is there are people out there who are selling their dream, not their skill.
Nice. Well, I'm a big fan of the trade plan anyway. I think trade plan's key to success. When we talked about coming on the program today, obviously we were going to talk about something that's going on in your world with regards to education, and you said I want to talk about the long, not the short of options. And I chuckled a little bit. I'm like, all right, Larry's always good at this topic. So tell us why that's the topic, and where do you want to go with it?
Well, a lot of people hear all the time, and I teach options. I'm an avid option trader. What I find is that there are people out there who have been told you only want to trade, or only want to sell options. And I ask them why, and they're like, well, you can't make any money buying options. And, there's some truth to that, but there's not. And so what I really started to delve into is this idea that, when we start to see ourselves at all-time highs, like we've been seeing in the market, what people have to remember is there are certain times that, yes, selling might seem easier because you're getting a particular premium up front, and maybe not have as much risk, because, if it goes in one or many directions, it could still win as a selling or credit opportunity, but they're missing more opportunity being a long trader. And so what I'm talking about here, I don't know, Merlin, you want to bring up a chart of, say, the SPY real quickly?
Sure,
if
I can
you
do
had
that.
basically gone into the SPY a month ago, and I'm going to show you an example of this shortly. Okay, what you have to understand is people have this belief, and the only time I would disagree with this is around earnings, that if price is dropping, we are not going to see the volatility drop as well. Usually when there's more volatility in the markets, if anything, volatility is going to go higher. So why wouldn't I want to consider buying puts at an area where price is more likely to turn? And then instead of selling something which is a very limited premium, have the opportunity to go ahead and go long. So if it's okay with you, I'm going to share my screen with everybody here.
Yeah, of course.
Right now. And let me bring this up here. Okay, I'm going to bring this over here. Sorry, guys. Should have had this ready. Can you see this okay, Merlin?
I see half your screen. There you go.
How about now? Okay,
Yep.
Let me get myself out of the way here. And so here's a typical thing that tends to happen with students and traders all the time. Now, number one, what caught my eye here, and you can see my mouse, yes?
Yep.
Okay, we had this M form. right over here. To me, this is an opportunity to say we might see a reversal in the markets because I've been trained to time the market. What I find most people doing is they spend too much time in the markets and not really learning how to time the markets. And so when I saw this big gap up here and the next day this came out, now notice the volatility was already high. But when price started to drop here, volatility, if anything, did what, Merlin? I'm going to ask you this question. What did volatility do while price was dropping?
Surging.
Exactly. So I started to go under this belief of, this doesn't seem to make any sense. Why would I want to go ahead and sell something when there was clearly an opportunity? If price were to drop, this could go even lower. So I want to show everybody here is that if I go back to February 10th, this is what I was looking at, and we said, okay, I'm willing to go out to a May option right now. And I look at the 459. So I'm right around that area, okay? The 459 is around the area of where price fell. I could buy the option contract for $2,356 per contract. Now, I get it. To some people, that might be expensive, and selling might be a better option just because they can't afford to get in. But here's something that I know no matter what, right? When I buy an option, the most I can lose is the premium that I pay. So if I'm willing to be okay losing $2,356 versus shorting at this point, which would have been putting up $44,932, I'm taking advantage of leverage. I already know there's a good chance that price is going to go lower. So I went ahead and I bought the 459s. Now looking over here, a month later, boom, this is what I want to show everybody here. I'm sorry, is that that same option was now worth almost $43. So we went from $23.56 to $42.54, which would have been about $2,000 in 1 month, or 81%. Now I put the comparison down here to show everybody that the best I could have done selling a credit spread using the same strike, a 459 by 464, number one, I would have $500 of risk. Okay, so yes, that's a little bit more expensive than a little less expensive than $23.56. However, the most I could make on this trade was $250. So at the end of the day, what I've done is say, okay, rather than just lock in $250, I locked in almost $2,000. And so I want to just understand here that we have to be willing to do a couple of things. And I'm going to share what I do to make that decision. But as everybody again see here, that this was kind of a no-brainer to me. We were seeing this beautiful break here. We got below here. There was no reason not to jump in here on the 10th and take this trade. And as a result, I stayed in it in a month, got out the same amount of time I would have stayed in if I did a short at this point, and I made a whole lot more money. So my point of this is there are opportunities and times, and the only exception I would make here is around earnings, because we anticipate after the earnings announcement ends that the volatility will go lower. This was a completely different situation. This is the market selling off right now, and we haven't really seen that in a while. And when that M formed, it gave me permission to take a trade. Worst thing, I could have gotten out before if I was wrong and not lost the entire amount of premium. But again, it was a great opportunity. And what people to understand is if you know how to time the market and you know where there's a higher probability that price is going to sell off, like it was here at supply, then why wouldn't I have taken that opportunity rather than just doing the safer thing by selling the calls right now? And that's why I'm putting out there, Merlin, that yes, I would agree that if I'm in a short right now, my goal is to not only see price here fall, but also to see the volatility go down as well. Well, price did go lower, but volatility kept going higher, which would have offset and taken a whole lot longer to get to my 250 than what was happening here with my stock. Because as a buyer, this was the perfect scenario for me. Price dropped, volatility went up. Yes, I had decay, but this is why I was able to make so much more over that given month, because I got a bump not just from price dropping, but from volatility going up as well.
You know, in everything we do at OTA, at least, it's done from a risk management perspective. And I got to ask, you know, with this, you started off, giving the example of the M pattern, and that's going purely directional. And then you said, well, that compared to, let's say, doing a spread trade, I would have earned a lot more. And I think it's just a matter of personal preference. We find ourselves in situations sometimes where all your proverbial ducks line up in a row and you go, okay, man, this looks really good. It's those types of situations where you may say, okay, I'm just going to go directional and buy some puts at this level. Or if you're looking at it and you're going, you know what, it looks pretty good, but I'm still not really convinced that we're going down, then you could maybe go with that spread trade. So I think, there's that old adage that you cannot get more reward without taking on more risk. And I do agree with that philosophy, and therefore it's up to each person to determine, do I want to go with the spread here, maybe make a little bit less, but I'm also not risking as much, or go purely directional where I am putting myself in a position to make really big gains, but I could potentially lose a lot more. And that's just a decision that we all have to end up making ourselves.
Yes, but I completely agree. However, what I'm addressing is the people who say, oh, you should never buy at all.
Oh, right.
Only sell options. That's where I started with this. Now, again, had price rallied instead of going down, you would have been punished on the credit spread as well. So again, it really is a personal decision. I also started off by saying, if you can't afford to do this, then the credit spread is the better path. But what you got to start to understand here is that there are going to be situations where it makes much more sense to go long than go short. And again, the reason why most people don't is because, one, they don't understand timing the markets. They don't understand core strategy. So if I tried to go long somewhere around here, not really understanding where I'm going to be in that particular scenario, because remember, it's about two things, Merlin: location, where am I in the bigger context of the setup, and two, do I have the right setup here to be able to make that right decision, to your point. To me, it was kind of the same. If price had gone up, I could have gotten out with my stop. I would have lost a little bit of money. If it had gone up too, I still could have lost money on the credit spread and lost the whole $500 if this thing really rallied. So you're absolutely right. It's a personal choice for sure. What I'm just trying to go out there and say is that I'm not scared of buying. Okay, I know that I have a guaranteed loss. Whatever it's going to be, I can manage that with proper risk management, but I don't want to leave opportunities on the table just because someone out there told me you should never buy options because it always goes out worthless. And that, to me, when I hear these kind of silly absolutes, this is why I wanted to jump on with you today to tell people, yes, you can do it. Now, what I'll share with everybody is there's some rules about doing it as well. It's not just blindly doing it, but I will show people what I did in my setup to do that.
I'm actually just had the wrong picture up here. I want to make sure I got the right picture up there, Larry. I got to make you look good. There's the picture I was looking for. All right. Cool. Let me take this back here, and I want to go to a listener question that came in, which I thought was a great one for this, and it ties right into our topic. Where was that one? Okay.
Chalupa.
What's that?
Drop the chalupa.
No chalupa. So Rich said, is selling poor man's covered calls a bad idea or okay to do as long as you understand exactly what you're doing? So this ties in with two separate questions. Obviously, selling a poor man's covered call, or there was a question that came in through here from Naum, said, Merlin, is that a naked call? So what Larry's doing is not a naked call.
No. Well, no, that's not true. I am buying a naked call. I am not selling a naked call. Just so everybody's clear, the term naked means there's no stock involved. So you're always buying naked call, naked options. You're always selling naked options. This is not selling a naked option.
I guess I look at it slightly differently. So for me, if I'm selling naked, that to me is when naked. I don't consider buying a directional option going naked. But you're right.
I get it, but just from a real terminology
you're
point. Right. Naked. I just want to make sure everybody understands that when you hear naked, it's both buying and selling.
So yes, Naum, that would be a naked call or a naked put.
This is buying a naked put.
Yep.
So I'm buying a long put. That's what was done here.
All right. So let's go to the other question from Rich was, is selling a poor man's covered call a bad idea or okay to do as long as you understand exactly what you're doing?
Right. So let me kind of preface that. I don't think covers calls are bad ideas, provided you're going to sell the stock. What people do, and I've addressed a lot of this with some of the students, and I've really scolded them at times, what people do is they have stock, but they really don't want to get rid of it. but they're willing to sell a covered call. Now, remember, when you sell that call, whatever price or strike you're selling it at, you are now obligating yourself to have to sell your stock at that price. And what happens is, because we start to see up high right there that we are buying that naked call or selling that naked call up there at supply, I'm making this a long example, that as price starts to rally, that call price or strike is going to get more expensive. So when we sell something and price starts to rally toward that target, the premiums on your short call will start to get more expensive. And what happens is, if you're saying, nah, I didn't really want to sell the stock, you're now going to be forced to have to buy that call back at a much more expensive price than you sold it. And to me, the purpose of doing the covered call is to lower your cost basis on the stock. I mean, let's just talk about that piece, and I'll talk about the mistake. Every time I sell a call, I could simply just buy the stock low, sell it high. If I choose to add that additional piece of turning it into a covered call by selling the short call against it, what I'm ultimately doing is bringing in premium that over time is going to lower the price of what I paid for the stock. That's really what you're doing. You're going to increase your rate of return and lower what you actually paid to buy the stock. Now, the problem is, if you're not willing to give up the stock at that target, then you're basically putting yourself in a situation where now you're going to pay more than what the actual strategy was intended to do. Now I'm paying for the stock, and now I'm paying more for that option. And I see people do this all the time. So my recommendation is, if you want to do the covered call strategy, you have to be willing to give up the stock. Now, it could turn out that that option goes out worthless, so you didn't have to give up the stock and you can sell another call against it. But as soon as that gets to 1 penny above your strike price at time of expiration, the stock's going to be taken away from you. And congratulations, not only did you get the appreciation of the stock, but you also got the additional money that came in from the premium of selling the calls. So I hope that answers the question. But again, don't do this strategy if you're not willing to give up your stock.
Yep, I agree. I'm going to show an example here for the viewers at home. I forget exactly when the execution was on this, but I had sold back when silver was up around 22, 23 bucks. I sold some $21 puts. And I was like, okay, that basically said I'm okay to buy it if it gets to 21. So it gets down here, it executes me, and fine, now I'm long a whole bunch of silver, SLV. So what I started to do is I was just selling covered calls at points where I thought I'd be happy to get rid of it. And every month I've been lowering my dollar cost, or my average price. So initially, it was $21 minus the premium that I'd collected. So that brought me to like $20.80. And the next month I'd collect another 25 and then another 32. So now I'm down my average price. Since every month I've been selling options on this SLV, my average price is no longer $21. It's actually much lower than that. I'm actually down at $19.85 right now is my average price on SLV, and I'm still selling those call options. Now, as Larry mentioned, I've got a 2350 right now that I've sold. I sold 32 2350 calls expiring this Friday, and if the price would have closed 4 days ago, my shares would disappear out of my account, and I'm fine with that because I collected premium and I get to basically keep that. Right now, it's at $23.11. So if this market closes below $23.50, well, I get to keep my silver, and I'll sell another set of call options for the next month, or maybe I might even do weeklies from this point on out. But that's just a real example of a trade that I have going on right now with SLV, where I'm okay to sell at $23.50. If it happens, it happens. If it doesn't, great. I'll keep selling calls against that position.
Absolutely. And it's really just dangerous because people didn't intend to do that. Now they're forced maybe into a decision they didn't really want to do.
Mm-hmm. Tom asks, he says, in a spread, I don't see volatility playing as much a role since it affects both sides of your spread, right?
Well, but again, it could, in that ultimately as volatility goes lower, even with the spread itself, it's going to reduce at some point. You're going to have some vega. It's just going to be a netted vega number as opposed to a full vega number. So there is an impact to it. But the same thing can be said, and that's why going long right now, if we're really in a market condition that's falling, and we're talking about a very volatile time in the markets, then this is an opportunity to see that long put move much faster further. And if the volatility does what you hope, goes higher buying the long put, you'll get there further faster. And that's the reason why at that point, looking at the market conditions, it wasn't calm. We had a lot of uncertainty in the market right now with the war and everything that's going on right now. It did exactly what I intended it to do. I just saw that opportunity when it got into that M pattern to take a shot at it.
Sure.
And it tended to work out well.
Yeah.
Now, if you want, I can give you another example real quickly that I've been working on. I think this will be interesting for some of you. And then we'll take a look at the chart. And is my PowerPoint on screen?
Yep, you're still sharing. Yep.
Okay. All right, give me 1 sec. I want to blow this up. Okay, is that looking pretty good?
Looks clear as a bell.
Okay, so this was on Monday. It was this big gap down into Apple. Okay, and I like the setup here. And I kind of set a target of 171.85. And what happened was, again, I'm kind of testing this. It's not just me saying, oh, I wanted to see this versus that. So let me show you what I did. I was very interested to say, what would be the better choice right now? Doing an out-of-the-money call or going ahead and actually putting on a credit spread. So here you have a bull put spread on April 1st, 145 by 140. And then we're talking about their credit spread, bull put spread, 18 days till expiration. Max reward could be $110. Your loss would be $390 or less, depending if you actually got stopped out because you collected the $110 and it's a 5-point spread. Or going long out of the money call June 165 with 95 days till expiration. The most you could lose was $525. And therefore, if it does hit the target, it makes $171.85 if it got to around $15.04 of profit. Okay, so as you see here, 1504 is what the option could be worth at the target, less what you pay in premium. That would be $979 versus the $110 that you could collect. Well, I started to track it this way. So starting on Monday after the trade was entered, as of today, right now, the actual long call, the out-of-the-money call is up $200 or 38%. I'm tracking it daily on the short call because I can see that progression. And right now, looking here at the, I'm sorry, not short call, the bull put spread, you basically got $1.10, and right now it's at $91.50. It's up about 48%. So as you can see here right now, okay, it's a decision that you need to make, but at the end of the day, once I hit the $110, game over. No much more I can make. Right now, I've made more than that right now on the calls. I could literally get out of the call today, and I would have made more money than I made with simply selling the calls. I'm sorry, selling the bull put spread. I don't know, I'm the call head right now, the bull put spread. So I wanted to show everybody this. Now, can I share with you my thought process on whether I would take that or not?
I think you can. I think we'll be happy to hear your thought process.
So let me share this with you. I'm going to come into CliK for a second. And this is what the chart looks like right now, everybody. So it's doing exactly what I anticipated. But what I would have done here is this. On Monday, and I'm going to share with you a couple of little tricks that I do. So I went ahead and did the 165 calls, and it was all the way out here till June. So give me a second here just to come into June. And I basically come over here to the call side, and I go to the 165s. Strike this over here right now. It's going to be higher. What I look at on the 165 right now is I will go over to the extrinsic value portion of the option. So let's pretend I would do this today. Right now, with extrinsic value being $7.25, it's an out-of-the-money strike, so that's my entire movement here. I'm going to do a couple of things. I'm just making a little note for myself. So if we looked at it, and hopefully everyone's following along here, I went to the strike I'm interested in, and I'm looking and saying, okay, I have to make up $7.25 a price movement in order to be able to at least break even on this trade. So that's the first thing I look at and say, well, is my target beyond what I would even have to make? Because what a lot of people make the mistake doing is they buy these out of the money or they buy the calls and they don't really track, can it move further far enough for me to make the money that I need? So what I would do here is simply say, okay, two things I want to do. I come back to the chart And what I'm going to do is bring up average true range. And I'm going to say here on a daily basis, what can this particular, get this up here, what can it move in a particular day? Well, in a day, it has a movement of about $5.06 on average. What about a month, if I wanted to stay this in a month? Well, in a month, this stock has been able to move $16.70. Bingo. I need it to move at least $7.25. It's showing me over a given month that I basically can see it move about $17. So I know I'm doing okay there. The second thing I'm going to do, and I'll show you exactly what I would do here. My target again was, I think, 71. Look at that real quickly, because I don't have it all memorized. Let me just take a look at this here. There we go. So my target again is going to be around 171.85. So the second thing I'm going to do so everyone can see how I think is, so that's the first way. Do I have enough run room with ATR that price could do this and cover what I need it to do? And the answer for me there was yes. The second thing I like to do is I'll come back in and I'll actually put on the trade theoretically. And here I go, I'll put it on. Now let me just put this so it goes into the theoretical tab. I got to analyze 165, plan position. And I don't really care about analyzing it. What I'm going to do next is show you that right now, okay, if I was at 165, theoretically at this moment, I pay about 750. What I'm going to do is come up here to current price. And what I'm going to do is unlock it. And I'm going to put in my target price of 171.85. And boom, my $7.50 option has the potential at target to be worth $13.87. So I'm making almost 100%, what, 80, 90% on my trade right now if I just left it alone. I do place a stop loss as well if I'm wrong, but these are just some of the things I'm thinking about right now. Do I have the run room, which it looks like I do, to get from demand, come back over to the daily real quickly again, from demand up to my target, which so everyone can see is right here right now. Now I can say this because it already left the station, right? But you guys saw that I put this on ahead of time. So it's about right around here. That's where I'm looking. I'll just come in here and put the actual price, 171.85. And now at this point, since I'm profitable, it's my choice how far I stay in this. If I see a little bit of an uptrend start, I can move my stop right here. It looks like the beginning of a little bit of a zone here. A little bit of a, rally over, wick over wick. And so maybe I move my stop right above here, still be profitable at the end of the day. So I think we have a little bit of room still to go up here. We might hit a little bit of resistance here. But again, because I can make the potential of more money on the call versus the credit spread, the only thing I'm worried about right now is I don't think the volatility is going to change as long as the market keeps going down, or if it does, not that much to slow me at this point. So that was my thought process. I hope that helps some of you, but that's what I'll do before I even put on or think about putting on the trade. Does it have the potential to do what I'd like to see it do? Any thoughts on that, Merlin?
No, I like it. I mean, I think that it just echoes what we always talk about, which is planning. It's one thing to throw a dart and say, oh, I'm going to make money on something. It's another to say, okay, well, what's the plan to make money? It's kind of like the example you talked about with going to the gym. I dread going to the gym in January just because January is just mobbed with all these people that are, I'm going to change my life. I'm getting back to the gym. And then they do 3 or 4 days and they give up. And next thing you know, they're back on the couch munching on Krispy Kremes for every day of the year. And then
you not to tell anybody that.
Yeah, but then you have people who actually have a plan in place, and getting yourself into shape isn't as simple as saying I'm just going to go to the gym. Well, if you sit in the gym and text message all the time, like all the losers do at the gym I go to, you're not really working out, right? Here's my schedule. Here's my diet. Here's my plan for how I'm going to attack this muscle group and cardio and sleep and all. And if you have that plan in place, you'll know how feasible it is, what the probability is of success for you, and you can start to actually physically map out your gains that you're going to get. Now, of course, I talk about exercise. This is just exact same thing, but mapping out trades. So I love it. I think what you're doing is above and beyond what the vast majority of people do, which is they just look at making money. You're saying, okay, yes, I'm going to make money. That's the goal. I want to make money. but let me see what all my downside elements are, and does this even have the potential to do what I think it's going to do, right? Is it going to reach my target? What's the chance there? And if it's acceptable, then take it. So I love it. I think it's great analysis.
You can map it to here. You can map it to here. I mean, whatever you feel comfortable with. Again, this is not to dissuade anybody from doing credit spreads. I do them all the time. This whole purpose is to say, don't be afraid of buying, especially if you're an OTA student, you understand how price works. I mean, there's no reason not to want to take a shot at this. And this would have been a 2-day trade that would have made $200. Some other people, I could do this as well, could have done a butterfly and I pay even less in premium and still be able to make that movement as price was going up. So there's a lot of different ways that we can go about this. I just don't want people to be so absolute to say, just because the volatility is high, I can't consider buying. You can if the conditions are right and you've done it enough to practice where there's going to be risk, of course, but the payoff could be much better than just doing a simple credit spread.
Absolutely. Joe says, core strategy equals guaranteed six-pack. Got it. I'm not going to say that, but I will tell you, I mean, if you, let's be honest, if everybody in here got a personal trainer and said, I'll do whatever that personal trainer tells me to do, and that personal trainer says, okay, you're going to the gym 5 days a week, you're going to stop eating, you're no longer going to In-N-Out Burger all the time, you can't eat this, can't eat this, can't eat this, and you got to do all these exercises. If you follow that to a T, I'll guarantee you a six-pack, regardless of what current weight position you're in. I mean, I think you can achieve anything if the rules are solid and you have a great plan on how to achieve it also. But core strategy, it's maybe a weightlifting core strategy would get you there. So you kind of answered this one, Larry, but as far as your decision process to determine the type of options trades you're getting in, you flip a bit. I know that you do directional, you do spreads, you'll be selling options as well. Is there kind of a quick hit checklist that you could say, like, for me, it's simple. If I see huge sell-off down days, well, that's the time I'm looking to sell some puts because I want to capitalize on fear when everyone's trying to buy puts. Days like today, when things are really ripping to the upside, well, puts aren't even, they're an afterthought. So I might be looking to buy puts today simply because no one wants them and the price of those were really cheap. Calls were expensive today. So that's as simple as I make it. Is there a strategy on your end, Larry?
Yeah, it comes down to what I teach my students in class. And I know some of you have been in my class. You've heard me say this over and over again. It took me years to really sit down and realize that trading options come down to two things. One is the where. So one of the specialized knowledge pieces that our students have at the academy is understanding where price is more likely to turn is a major odds enhancer for me. It tells me, for example, like we saw that previous one where there was that M, that there's a good chance that this is going to be a great bearish setup. Now, that just tells me because I'm near a supply area that I want to be bearish with the option. Here at demand, I knew I wanted to be bullish based on this zone. I really liked the setup here. I liked how it left the zone. I also liked the fact that I have the zone on zone right over here. So I felt this was a pretty safe bet to do this upon the retracement. And it also gapped, novice gapped right back in this area. So number one for me is core strategy. So if I am directional, and the thing that you got to understand is, and Merlin probably never heard me say this story, my students have, being a buyer of an option, you are an optimist. Selling an option, you're a realist. Because for us to make money, price has to move as a buyer. So where are we more likely to see price move? In the middle here, when there's really no zones, or at a directional qualified zone where I knew there was probably a good chance there would be unfilled buy orders. Now, when price came down here, and sure enough, that's exactly what happened on Monday, came in, pulled back, then really took off the last 2 days. If I'm in the middle here, then my preference, providing there's enough liquidity and premium, I will look to do credit spreads because I know that the chance of price moving as fast as it would at a zone is much smaller. So I like to do credit spreads once it leaves the station, provided there's good volatility. So that's really the simple part of it. So number one is, am I at a zone or not at a zone? Number two, what's the volatility? Is it high? Is it low? If it's low, then I want to be a buyer. I want to take advantage of cheaper premium. If it's high, that's when I'm going to step back for a moment and say, well, puts are cheaper due to the inverse correlation. So the puts would be cheaper all the way up here than they would be down around here. So it becomes now for me, if this is earnings, all this is off the table because earnings will have an impact on volatility. But if it's a normal trading scenario in the markets, and it's great, you can start doing these even on ETFs because they'll be much cheaper, a little less volatility. Why not take a shot at going long? So it really determines this, Merlin. One is price. If the premium is very, very expensive, then my mind immediately goes to a spread. So if I'm buying something, I look at a spread. If I really like the move, I might do a butterfly and reduce that premium even cheaper. So I've gone into some butterflies where I've paid $20 a contract. To some, you might turn around and go, wow, I could do that. I can risk 20 bucks. No big deal. And if it rallies, you have a great opportunity to make a nice rate of return. Like this could have been a really nice butterfly too, but it wasn't in my thought process because I was testing out the out of the money call. This easily could have been a butterfly right now, would have made a nice return just in these last couple of days due to this great impulsion that we saw off the demand zone. If again, this is something that's going to be in the middle here, I'm more likely to believe that price is not going to move that far that fast. And there's a good chance that I could do a credit spread, take advantage of collecting premium while I'm waiting for price to get back to an area where I might consider buying. So it's really that simple. What's the volatility? Where is supply and demand? And I put the right strategy based upon cost and time.
I like it. I like the simplicity of it. I think for me, it's critical to keep the simplistic aspect to it so that we don't overcomplicate things.
And consistency. So that's the key here. If you want to be a good trader, you've got to be consistent. We're not worried about breaking the bank. You know, I want to make a statement. I've said this many times, but I think this is important. Most people think when they start to invest in trade, they're doing it for the money. And that might be the initial reason, but most people who really get into this, like you and myself and a lot of the listeners today, it's really about freedom, isn't it? People want to have the freedom of choice to not have to do this or that or do things they want to do or not do things. The money is the catalyst for that. But the purpose and what drives me every day to become better in the markets is that chasing of freedom. And that really is what I've gotten the most out of being an OTA student. It's allowed me to feel more free and a little bit calmer because I have more rules. I came in 12 years ago, and I can tell you I'm smarter today than I was 12 years ago.
Oh, I don't know about that, Larry. Jeez.
No, hanging around you has dumbed me down, but I'm over that.
Oh, come on. And I like it because, you started this off talking about, there is a mindset that those who sell options don't make a lot of money. And again, I can't blame anybody for selling options to generate income streams or buying options to make bigger rates of return more directionally. And to me, it's just a matter of personal preference. As I've actually done a show on this specifically for TraderMerlin, which you can find in the archives of the show, where I just called the 1% strategy, right? I'm looking for at least 1%, sometimes I'm getting 2 or 3% per month, just doing nothing but selling options at really, levels that are 10% out of the money. Fine, if it drops 10%, I'll be a buyer of those levels. And it may seem boring, but it's extremely consistent, right? It's not the flashy stuff. There will never come a time in that 1% account where I'm going, boom, made 100% rate of return on that trade. It's never going to happen. However,
can I add one point to what you said?
Yeah.
Because what you said that was most important there, you have a strategy. Your strategy is the 1% strategy, and I completely agree with you on that. What I'm really kind of going after are the people who just say, don't buy, it's a loser's game. That's really the key here. And the more tools you have in your tool belt. And by the way, a lot of your listeners right now, I believe, are mastermind students. They come in every Saturday. They watch me put on a strategy that makes 5% a week. That's very consistent. That's very conservative. And I think that's the better way to play it if you want that kind of a strategy. But if you're a trader and you're looking to make more money, you can make money by definitely selling credit spreads, Absolutely. But you're going to have to put on more contracts to do that.
Absolutely.
Which means you have to be willing to take more risk as well. So that's the only thing you have to weigh that all the time. My argument is more of somebody saying you should only do this, and that's what I'm hoping to enlighten some of the listeners today. You can do different things. That's why options give you options. Don't pigeonhole yourself into just doing one thing. If the strategy you're planning includes either, beautiful, but have a plan. Just don't put in your mind that it's one or the other. I think it's all the above and then some.
I agree. Michael in the chat says, it seems like it always blows my zone by a few ticks, knocking me out and then rises as expected. So, Michael, I would just tell you this. If it feels like that's always happening, like more often than not, then it probably has something to do with your zone drawing. So I might go reevaluate how you're drawing your zones and try to learn from each one of those. Now, granted, every single person is going to have that happen to them, where you got your zone, it takes you out by 1 tick or 2 ticks or 10 ticks, and then just rips up and does exactly what you thought it was going to do. It's bound to happen. But if this is something that is extremely recurrent and it's like over and over and over again, then maybe there's an issue with how you selected your zones, and I would reevaluate. Take a step back, maybe to take a little bit of time off from trading, reevaluate your zoning process, how you're using ATRs and things like that, including if you're using options. Look at implied volatility and those other aspects, which may help widen your stop losses a little bit to accommodate for that fluctuation in volatility.
I don't know if they can still see my screen, Merlin, but I want to show everybody that you had the same opportunity that was in the SPY in Apple. Look at this. So basically, here was that M once again that poked its head up, and this would have been the place to get in. Imagine that you would have bought a long put right there.
And by the way, guys, I have 50 long puts on the S&P, which were pretty much the bulk of those were purchased at the tip of that double M. So I'm right there with Larry. I've been adding as it drops back down here, so I certainly have a lower average price. But my initial entry was as we came in and retested those highs on the S&P. Simple. I mean, I'm 100% with Larry on this one. I saw it as an opportunity of market weakness. Go to the SPY real quick.
Sure.
So if it brings up the SPY, you'll see, you have that same basic formation. And for me, it was just starting to make a lower high on the right shoulder of this head and shoulders piece. So I'm right there with him to the T. That's where I started building that short position. So
yeah, and again, a lot of it is just people learn, and again, you're learning different strategies, which is why, by the way, we start off with the longs.
Yep.
If we didn't think it would be a decent strategy, we wouldn't take the time to teach you guys the longs of this. But there you go, and here would have been that little bit of an area here, or right at the break, you can see this little retest was right back around this break here, and this is kind of where I was talking. Yep. And it had a nice little fall right around here.
Larry, I'm going to ask a real quick question that came in from Tom. We've got 17 minutes left, and I refuse to let these guys control me and make me do an hour show anymore. So Tom says, in class, you recommend to set a stop loss on a closing trade and check the trade 30 days later. I set up several trades, and they all gapped over the stops. I check the trades now at least weekly on a weekly basis. I also use TradingView alerts to back up. Did I get that set and forget for 30 days wrong?
Yes, because it's not actually a set and forget. What I'm talking about is, let's pretend in the Amazon, I must be having a weird day today. Apple,
you've had too much Merlin.
Exact example then, Tom. Let's say right here, okay, when I got in, I would have had a stop here below. The stop is the stop. What I'm talking about is I got into the trade here. In the next 30 days, let's say it didn't do that. It kind of went sideways like this and meandered a little bit. 30 days into the trade, if I'm not seeing it really in the motion toward my target, 30 days in, what I decide is, do I really want to stay in this trade any longer? Would I just want to take my profit or a little bit of a loss at this point, move on and put on another trade? So the 30 days doesn't really have anything to do with the stop loss itself. It's not a set it and forget it. It's basically, hey, I bought something 30 days after the fact. I'm going to take a look at this. My target's all the way up here. Price is still down here. I don't think it's going to get there. I'm going to make the decision just to take myself out, save some of the time value or extrinsic value portion of my premium, and go find another trade to take. So I hope that clears it up.
Yep. So I moved over the screen a little bit late, but yes, definitely. And I think it's just trade management in a nutshell. I don't have anything that I really set and forget 100% for a month and leave it. Even in my 1% strategy, which is a monthly strategy, I'm still checking on it and making sure it's not completely out of whack. So.
Right. So I hope that answers the question, Tom. And it's always great having Tom in the class.
Yeah, he's always great to have him in here as well. Mike says, Larry, do you put this type of directional trade into the OTA picks, or is that too much risk for an OTA pick? Good question, actually.
Well, and you say generally the option traders in the OTA picks, no, they can. It's just sometimes, it depends upon not so much from the risk factor, but it's just the instructor at that point, whatever they see, they're going to put on at that point. So some people might put on credit spreads, others put on long directional trades. It really is based on the markets. Again, if you start to see price mostly between two zones, most of the time you're going to see instructors putting on the credit spreads, especially, let's say right now I missed this and I came in and the volatility was high, then I might have yesterday decided to put on the bull put spread because it already left the station, right? I already missed the opportunity to put something on when it actually hit the zone. So that might be another factor too. So again, it really is location. It's where am I in relation to supply and demand? What is the premiums that are being offered? What is volatility? And that's why I always encourage students, you don't have to guess. We spend a lot of time in class, and some of the students who have taken the classes want to chime in, they can agree or not, but we really do a good job of really explaining every aspect of the options world so that people can make the best decision they possibly can. What people have to get more comfortable with, like you said, Merlin, is what's better for them. What do they feel more comfortable with? But you can create trades, even being a buyer, that can have less risk than doing a credit spread. Like I said, if I had done a butterfly, it might have been maybe $1, and now I'm only risking $1 compared to risking $5 in a spread. So it's all relative, but the key here is I've got to be really good at timing the market. If I'm not, that's where I see most people struggle and make their mistakes.
Agreed. Tom responded back. He says, question was more about jumping the stop. So, all right.
Oh, I mean, if the stop goes out, then you would be out at that point. Your stop loss would take you out, your stop market.
It should, yeah.
So, yeah, that should take you right out if you have a stop market. Even if it gaps below the stop, the second it opens, it's going to fill you at whatever the best possible fill would be because it was a market order. So again, you still have that protection. But I rarely do set it and forget it. In fact, if you go, some of you who are OTA students, if you go to my OTA, my resources, Hour with the Instructor, you will actually see a little video I did called Managing Your Trades. And I talk about how to trail your trades, both with multiple targets and stops, as well as trend. So I'm very much not a set it and forget it type of guy. I like to keep my eye on things because things could happen like trend breaks. And I don't like to sit in something because I was told to do that. It's more of a personal choice.
I'm bringing up your, I'm trying to find out, see, there's the Larry part. So you just type in his name, he's got practice makes perfect. Oh, this is from 2020.
Yeah, I did it like 2 years ago.
Wow.
Yeah.
So you put this guy into lockdown mode and go into quarantine. He starts recording a bunch of videos. We should go into quarantine more often. Get you making more videos.
I want our students to be successful. I want them to be happy. So if I can pull an hour to do something, I'm going to do it.
Yeah, awesome. Well, Larry, tell us a little bit give us a gratuitous plug for yourself. You can stop sharing your screen now so we can see your lovely mug. But give us a gratuitous plug for what you're doing. I know you've got tons of classes going on regularly. You're always out helping the community. You're the guy who's in at OTA at 4 o'clock in the morning and leaving at 8 p.m. as I'm Fred Flintstoning out of the building. So tell me what's going on in your world and where can they find you?
Well, we're basically doing a lot of retooling on some of the strategies. I'm working very closely with Todd Davis now, and we're always thinking about how can we simplify things. We're constantly testing new things. One of the things I've gotten more involved with, crypto. And I actually started to be staking now. There's a couple of opportunities I've really been liking, and I'm just kind of building a position in it for the future. So I have kind of 3 things in the world of crypto going for me personally. Some things I'm really speculative of, some things I want to be more long-term, and some staking things where I'm just, thank you, Merlin, collecting money for doing absolutely nothing. So I like to be Fred Flintstone too. As far as teaching, I'm going to be in Woodland Hills in April doing an Options 2 class. I don't teach that much anymore, but since I did it down in Irvine, I'm going to be out in Woodland Hills. I'm also going to be in DC, I believe, at the end of April doing an event with the DC students. So I'm excited to do that as well. Other than that, I've been doing every Saturday in the clubhouse for our mastermind students, a 2-hour session on how to trade weekly options. A lot of people are interested in weekly credit spreads, and I wanted to make sure they knew how to do it the right way with a proper set of rules. So I really get excited. We get about 200 students a Saturday coming in. So that's pretty humbling, the fact that there are people who want to take time that they could be out anywhere to learn a craft. I love that. I will support that.
Awesome, Larry. Well, hey, I appreciate you taking the time to come on. It's been a few months. I'm going to keep bugging you to get you on maybe once a month. I love your input and your energy, enthusiasm, help people achieve their dreams in the market. So thank you for sharing the long, not short of the markets, and I will see you at Benihana in a few hours.
You got it.
All right, Larry. Thank you so much.
Thanks, everybody. See you soon.
Bye.
Bye.
Guys, that was Larry Jacobson of Online Trading Academy. You can find out more information by going to Online Trading Academy's website. And I guess since I always end up showing like other websites, I may as well show theirs, right? So here's your Online Trading Academy. This is, of course, I'm logged in, so I guess I should probably log out here. But if you want to know more information about Online Trading Academy, of course, visit their website. Larry does a bunch of teaching. He mentioned his upcoming classes. Pretty simple. He'll be at Woodland Hills teaching options too. So if you're in Los Angeles, check that one out. DC doing an event for them. Who knows if that's an online event or not. And then you have Saturdays, that's Clubhouse. Do weekly options. Kind of cool. I like that little weekly options session. I know I saw a question here from somebody asking about OTA strategies just 90 days out. I have to say I completely disagree with that. There's parameters that in the options structure, if you will, where you're saying if you're buying of options, you need time. You need time is your enemy, so you want as much as possible. If you go short term, let's say you bought a 30-day option expiration. It's going to expire in 30 days. That thing is going to be losing so much value each and every day. It's just not worth it. So, for me, 90 days minimum, I'll go out to 120 days or maybe even more than that if I really feel like I need time as a buyer. As a seller, I want to sell 30 days or less. If I can sell weekly options and get my 1%, I'm going to do that. And I have done that quite a bit. Most of the time, I'm selling an option that has a 30-day expiration, at least part of my 1% strategy. There's others, which Larry mentioned, doing weekly options, which is a much more active. It's a little more stressful because, obviously you're doing a lot more trades, a bit more analysis. But I think once you get that routine down, it can be very profitable. Again, it does have its set of risks, as everything does, right? They're all going to have their little risk and reward. So don't hang your hat on the fact that I said you can make a lot of money at it. You can. You can also lose a lot of money. So, make sure that you have your risk management in place, which is the ultimate to getting everybody to succeed in the financial markets. Let's see. Merlin, Larry, why do people skip signing up to learn these skills until they have gotten burnt by the market? I don't know. It's really challenging to say. I think a lot of people feel that they can go out to YouTube and find some video of somebody and just be like, okay, I know how to trade. And I think it's a little more challenging than that, in my opinion. I think that it requires a deep commitment. It requires a community. I think that's a challenge. But a lot of us have egos. Oh, I can do this. I can do this. I don't need to pay the money. Granted, OTA can be expensive. I know that that's one of the big obstacles for a lot of people. But I've always had the mindset, you get what you pay for. And when you're in a big community that has tons of support tools and trade review sessions and all different resources for you, that's where a lot of the value is. So I think it's just people's stubbornness that they don't want to spend the money to do it. I'm fortunate that I'm probably one of the stingiest people with money you'll ever meet. I am pretty tight with money, and I normally don't just spend money. I'm a hoarder of capital, right? I want to keep growing my net worth. But early on, I saw the value of it, and I said, okay, I'll shell out. At the time, it was a 30-day class for Online Trading Academy. It was back in 1998, and I think it was $5,000. That was a lot of money for me as a young kid to shell out $5,000, but I saw the value. I was like, I know that this is worth it, and this will shortcut me through a lot of trials and tribulations. So I did that. What did Lisa say? Jordan Matthews did a session with us last Friday, Simple Options, where he went over where he bought puts, recognizing gap exhaustion, similar to what Larry showed us tonight. Recordings available. Cool, nice. And again, and this is what makes it so good being a part of that community, right, Lisa, is, yeah, you've got Larry, you've got Todd, you've got Jordan Matthews, you've got a whole bunch of other instructors that are all going to share their little strategies, and you might resonate significantly with one of them. And to me, that's really important because you can learn from that individual, find their strong suits, and see what works for you. All right, let me just look at the economic calendar for tomorrow. Of course, we didn't even look at the charts today, which is a rarity, but we had, according to this right here, a 25 basis point increase in the Fed funds futures rate. That was no shock. What was interesting, at least for me, was Powell pretty much made it clear 7 rate increases this year. Of course, I talked about that over the past week. You can look at the Fed funds futures. They'd already priced in 7 rate hikes this year. So we started today off with a 25 basis point increase. What I found interesting, though, is look at some of this economic data. I mean, we went from 4.9 on retail sales. They expected it to drop to 0.4. Came out at 0.3. So a much bigger contraction than expected in retail sales numbers. We also had business inventories contract. The NAB housing price market index, that is also shrinking. The only thing that went up here is crude oil. Came up on the day to 4.3 million barrels surplus, not a contraction, but actually an increase in oil production, at least the number of barrels of oil in our inventory to 4.3 million. So that was the exciting piece. I guess if we look further down this path, we can look at some of the price charts here in just a second, but let me get you economic calendar for tomorrow so we can set that all up. Tomorrow I'm going to have Bill Addis on the program. We're talking about what Powell talked about today and what this might mean for the rising rate environment. Here's what we have cooking. Philly Fed Manufacturing Index, unemployment claims, you have building permits, housing starts, industrial production, and capacity utilization rate tomorrow. And for those of you that like juggling fire, natural gas storage numbers come out tomorrow. Natural gas has been incredibly volatile lately, and I don't see any signs of that slowing down anytime soon. Let me bring up a chart of NG just so we can see that one. A few charts noteworthy here. Check out the 10-year today. On a 5-minute basis, you look at what the 10-year did. It was a crazy rip up and then just screamed back down on the 10 here. Natural gas, here's your natural gas chart. You're talking some pretty significant swings in natural gas as well. Looks like it's trending up here, but we'll have to wait and see. Those inventory numbers might have an impact on this one. And then the indexes. This is really the crazy part, was watching just monster moves in the S&P, the NASDAQ, the Russell. NASDAQ up 4%. That was just crazy. This was right as Powell came out with the announcement. We ripped down. It was just crazy sink there, and then all of a sudden, just monster rally. It was a weird day to be sure for the S&P. It's funny because obviously I'm holding some pretty sizable long positions. I did dump 30 of my Russells just as we broke through a level from a couple days ago. Let me go into an hourly here. Yeah, where were we? This level here, as I broke above 2,000, that was my trigger to get out. So unfortunately, out of 30 of those Russells, that's my June expiration, but I still have the Mays because I'm still deep in the money on those ones. So there you go. 7 rate hikes in the next 9 months. Yep. Yeah, it should be easy. Tom, you just like to telegraph everything, right? Let's say they already done it. Let's just say we're going to do one a month. One every meeting, for the next 9 meetings. They don't want to do that. They need to keep themselves busy, so it was tough. All right, anyway, that was your announcements for the market. I didn't get a ton of time to dive deeper into those, but I got to run. Again, I have so many things going on. I've got my Crypto Investor Live this tomorrow morning, and then I can finally relax for a little bit. So, yeah. That's pretty much it. Again, if you guys have comments, questions, feedback, do me a favor. You've been putting them down below the YouTube. Les, I know you asked 2 questions, or 3, that I didn't get to today. I'll do my best to get to those tomorrow, but make sure you guys put your comments down below the YouTube videos. Like I say, I've been told that helps me. Who knows? I haven't seen my viewership spike or anything like that, but I've been told it helps, so put your comments down below the YouTube videos. If you have personal questions, you can email me at TraderMerlin@gmail.com. I'm happy to answer those. Until then, happy trading, everybody. I will see you all tomorrow with Mr. Bill Addis. Take care.